Into silent, high-altitude boardrooms of Manhattan, there is one name that carries more weight than any central bank or government treasury: Blackstone. For decades, Blackstone hasn't just participated in the market. They have been the market. As the world's largest alternative asset manager, they turned the basic human need for shelter and office space into a global financial engine of unprecedented scale. But in 2026, that engine is beginning to emit a sound that the financial world hasn't heard in nearly 2 decades. The grinding, metallic screech of a machine running out of oil. The headline that the mainstream media is afraid to dissect is not about a stock market crash or a sudden bankruptcy. It is about something much more clinical and far more dangerous. The suspension of redemptions. When Blackstone's multi-billion-dollar real estate investment trust, known as BREIT, begins to throttle the amount of money investors can take out, it isn't just a corporate policy update. It is a seismic shift. It is the moment the world's largest landlord admits that the exit doors are smaller than the crowd trying to rush through them. Imagine a luxury skyscraper in the heart of Hudson Yards. To the casual observer, it is a monument to New York's eternal growth. But to Blackstone's accountants, it has become a frozen asset. In an era of high interest rates and 22% office vacancy, the math that built these towers no longer works. The debt used to finance them is becoming more expensive every month, while the rents used to pay that debt are evaporating. This is the Blackstone exit. A desperate, quiet attempt to stabilize a ship that is taking on water in the most expensive real estate market on Earth. To understand why this is happening now, we have to pull back the curtain on how these private equity giants value their holdings. Unlike a stock that you can sell in seconds on an exchange, a 50-story office tower is illiquid. Its value is whatever an appraiser says it is. For years, Blackstone and its peers have relied on what critics call market-to-model accounting. They don't value their buildings based on what a buyer would pay today in a distressed market. They value them based on internal models that assume a return to normalcy that may never come. But in 2026, the gap between the model and reality has become a canyon. When a prime piece of Manhattan real estate is sold at a 40% discount task, we are seeing with increasing frequency the entire house of cards begins to tremble. If one building is worth 40% less, then the building next to it, owned by Blackstone, must also be worth less. This creates a valuation death spiral. If Blackstone marks down the value of their assets to reflect reality, their investors will panic and demand their money back. If they don't mark them down, they are holding zombie assets that no one wants to buy. This is the trap. The liquidity that once flooded the streets of New York, turning every old warehouse into a luxury loft, has dried up. The smart money is no longer looking for growth. It is looking for the exits. But when everyone tries to exit at once, the gates are locked. This is the withdrawal freeze, and it is the first stage of a systemic reckoning that will leave no corner of the American financial system untouched. The crisis we are witnessing isn't just about Blackstone. It's about the fundamental belief that real estate is a safe haven. For a generation of investors, Blackstone was the gold standard. They were the ones who knew how to navigate every crisis from 2008 to the pandemic. But 2026 is different. This isn't a crisis of demand. It's a crisis of fundamental structural change. The office is dead, the debt is expensive, and the largest player on the board is running out of moves. But the true scale of the Blackstone exit goes far beyond the billionaire class. This is where the story becomes personal for every New Yorker and every American worker. Blackstone doesn't just manage the money of the ultra-wealthy. They manage the life savings of teachers, firefighters, and police officers. Through massive pension fund allocations, the retirement security of millions of people is tied directly to the valuation of these zombie towers in Manhattan. If Blackstone cannot meet redemptions, if their real estate funds continue to lose value, the shockwaves will travel through the pension systems of the entire country. We are talking about a wealth erosion event that could wipe out years of retirement gains in a single fiscal quarter. The sophisticated algorithms and high-frequency trading platforms of Wall Street cannot hide the fact that if a building is empty, it has no value. And if it has no value, the promises made to retirees are nothing more than ink on paper. As we move deeper into 2026, the Blackstone exit will be remembered as the moment the illusion of infinite urban growth finally shattered. The skyline of New York, once a symbol of indestructible wealth, is being revealed for what it truly is. A collection of distressed assets held together by hope and creative accounting. The machine has seized, the doors are locked, and the reckoning is here. The true abyss within Blackstone's balance sheet isn't just what they have lost, is what they are refusing to admit they have lost. For a giant of this magnitude, asset valuation is not an exact science. It is an exercise in narrative survival. In the world of private equity, there is a core concept called mark-to-market, which essentially means valuing an asset based on the price the market would pay for it this very second. However, in the commercial real estate market of 2026, the market has effectively ceased to exist in its traditional form. There are no buyers for $500 million office towers in Midtown when interest rates are at 2-decade highs and remote work has left 22% of the city vacant. Faced with this vacuum, Blackstone and its competitors have retreated into a world of shadow accounting. Instead of adjusting their prices to the brutal reality of foreclosure auctions, they keep their buildings valued based on internal models that assume a miraculous recovery. It is a form of accounting alchemy. If they were to admit that their assets have plummeted by 40%, as suggested by emergency transactions across Manhattan, the net asset value of their flagship fund BREIT would evaporate instantly. This would trigger a panic clause. The exit gates would close, not for weeks, but for years, trapping the capital of pension funds and institutional savers in an unprecedented liquidity trap. This accounting nightmare creates what analysts now call zombie buildings. These are properties that, on Blackstone's books, are worth hundreds of millions, but in physical reality, they are dead. They do not generate enough cash flow to cover debt service, yet the bank and the fund enter into a pact of silence to avoid declaring an official default. It is a gentleman's agreement to prevent the first domino from falling, but the problem with financial gravity is that it cannot be ignored forever. Every month that passes with empty offices, Blackstone's cash reserves are drained just to maintain appearances. We are witnessing a silent erosion that, when it finally breaks the surface, will not be a correction, but an implosion of trust in the very value of American brick and mortar. Liquidity is the lifeblood of the New York system, and Blackstone is the heart that should be pumping it. But that heart is suffering from a massive arrhythmia. The phenomenon we are seeing in 2026 is the digital liquidity dry-up. In 2008, people stood in lines at banks. Today, institutional investors simply withdraw their capital with a click, or they try to. When Blackstone imposes limits on redemptions, it sends a distress signal to the entire ecosystem. If the world's largest landlord cannot generate cash by selling its properties, it means the commercial real estate market has frozen solid. This freeze has devastating consequences for shadow banking. Blackstone doesn't just buy buildings, they lend money. As their own liquidity dries up, they stop financing new projects. This brings construction across New York's 5 boroughs to a grinding halt. Cranes that should be moving in Hudson Yards stand static, becoming steel skeletons that symbolize the end of an era. Credit becomes selective, almost punitive. Local developers who relied on financing from these massive funds find that credit lines have been closed overnight, without explanation. What makes the situation unique in 2026 is that there is no white knight. In previous when a large fund faltered, a larger one absorbed it. But today, everyone is in the same trap. Exposure to Manhattan offices is a poison found on every balance sheet. Foreign capital, which for decades flowed from Hong Kong, Dubai, and London to sustain the New York skyline, has evaporated. International investors have realized that New York is not immune to the laws of economic physics. They have seen the hybrid work model become permanent and have decided their money is safer anywhere else but in a half-empty glass tower on 6th Avenue. We are reaching the breaking point where corporate narrative crashes into mathematical reality. Blackstone has tried to pivot toward data centers and logistics to offset its office losses, but the weight of commercial real estate is too massive to ignore. It is a dead weight that threatens to sink the entire structure. The interconnection between these funds and regional banks is the high-voltage wire that is about to snap. If Blackstone begins a fire sale of assets to meet investor redemptions, the prices of every property in New York will plummet, destroying the collateral for thousands of bank loans. This is the systemic reckoning. It isn't just about whether a company makes or loses money in a quarter. It is about the validity of the debt model that built the modern world. If the most solid asset in the world, New York real estate, can lose 40% of its value in a high-rate environment, then the entire global credit system must be re-evaluated. Conversations at the highest levels of the Treasury and the Federal Reserve are no longer about how to avoid the crisis, but about how to contain the fire so it doesn't consume the savings of an entire generation. The Blackstone exit is the first serious crack in a dam that everyone swore was indestructible.